Okay, peeps, welcome back. So today we're going to be talking about the CPI expectations for November of 2023, which is this month. Will inflation drop so the Fed can cut rates? Let's get it. So the important thing to note about the CPI data is that it's always looking back a month. So the CPI that's released for this month will be for the data that was showed in October. So that's just kind of how it works. I'm going to show you guys here on the actual labor and statistics website so you can see for yourself. So you can see we got all these CPI releases going forward, but the one we're looking at right now basically is this one right here. So the release date is coming up here shortly on the 14th, which is Tuesday. And the reference month that the markets are going to be looking at is last month. Okay. So basically, the information, the data for last month is going to be released this upcoming week. And this is at 8:30. This would be Eastern Standard Time. So if you're on the East Coast, then this would be 8:30 in the morning. And if you're on the West Coast, then that would be at 5:30 in the morning. And then, of course, your respective time frames accordingly to whatever part of the country you live in. So let's go ahead and talk about what the actual estimates are. So according to this blog on morningstar.com, and I'll leave this in the description for you guys to take a look at for yourself if you're interested. But it says that October CPI report forecasts to show overall inflation moderating. That's what we want to see. We want to see inflation come down so that way the Fed can be like, okay, inflation's under control. We can start cutting rates. That's what we want. The sooner we get through the rate cutting cycle, the better, because as soon as that's over, then they go back to printing money and the stock market goes up for basically another 10 to 15 years. So that's pretty much what all investors want to see, not just stock investors, but crypto investors, bonds, you name it, basically anything. Maybe except precious metals, because precious metals do generally sell off a little bit once the Fed starts printing money again, because metals are kind of seen as like a hedge against an economic collapse. So usually when there's a recession, precious metals go up in value, and then the inverse is true. So anyways, with that being said, let's read the article. So it says the consumer price index for October 2023 is forecast to show a continued overall decline in inflation, led largely by moderating energy prices. However, economists expect CPI, or core CPI, which excludes basically food and energy, to show stickiness rather than improvement, holding at levels well above the Federal Reserve's target. What is their target? Their target is 2%. Okay, that's their goal, 2%. According to FactSet, the overall CPI is forecast to come in at 3.3% annually. This would be the headline inflation metric, and we're going to take a look at these on the chart here in a minute. And that would be down from 3.7% in September. So again, the release for the September data would have been last month. Meanwhile, core CPI is expected to remain at September's levels with 4.1% increase from a year ago. So I just am going to read that part. I'll leave the rest for you guys in the description if you want to check it out for yourself. Here's a kind of a neat little graph displaying what inflation has looked like over time and where we're at now. As you guys can see, we're doing much better now than we were pretty much in May and June of last year. Core CPI was at almost 6%, and headline inflation expectations were over 9%, which is pretty crazy from these 2021 lows here, as you can see. But this dotted line would be the 2%. This is presumably the Fed's goal here. As you guys can see, once it got above that, that's when things really started to take off. So you can look at this in your own time. But the important thing to gather from all this basically is if headline and core inflation come above the expectations, there's a pretty good chance that the markets may sell off. Because what does it mean? Basically, what it means is if inflation comes in higher, it means there's a good chance that the Fed may raise rates again, and that causes borrowing to be expensive, as you guys know. And when borrowing is expensive, demand generally slows down because a lot of people want to go spend a lot of money, and consumerism and businesses have to, make money and all that jazz. And it makes business loans, personal loans, credit cards, auto loans, home loans, all that stuff much more expensive when the Fed raises rates more. But on the flip side, the Fed can't raise rates too much in theory, because if they do, it makes the interest payments on the United States debts more expensive to pay, and at some point it becomes unaffordable for the United States to pay those debts. Basically, where they're in the negative, they're actually they're not able to pay the debts because they just simply don't have enough money to pay on the debt that they owe to these other countries and whatnot. So the other the other side of it. So that would be if inflation comes above expectations. If it comes in below expectations, like if we get something like this where the headline inflation comes in lower than expectations, but CPI sits basically flat, then the markets may kind of have I would say like a neutral response to it. They won't go up, but they won't go down. We might see something like maybe like a rip to a sell off to a rip, something like that, or something opposite of that, like a sell off to a rip to a sell off. And then it just kind of bobs around until the FOMC meeting. But if both come in below expectations, expect the markets to rally, because at that point they're going to see that inflation's coming down. So therefore the Fed doesn't need to continue, basically fudding the market and be like, oh yeah, we're going to raise rates 10 more times, guys, or whatever it is that they decide to say from week to week. So with the CME Watch tool, this is basically showing you guys when the next FOMC meeting is going to be. This would be December 13th. We can actually verify this here. So we're going to type in FOMC meetings. Type FOMC meetings, go to the Federal Reserve's website. They actually show you what the meeting dates are. So this is 2023. You can see the last meeting date here is December 12th to 13th. So that is actually accurate. And again, here is December 13th. So basically, pretty much from the looks of it, pretty much the markets are expecting the Fed to stay at a pause. So there's a 90% chance of that taking place as of currently. And again, these numbers can change. It depends on inflation. It depends on the labor market. That's another metric that the Fed takes a look at, but we have not covered that yet because we don't feel like it's really relevant yet, or it's not the most important piece. The amount of importance that it has in comparison to inflation is smaller. In our opinion, we think inflation is more important right now than the actual labor market, even though the two technically work in tandem together. So we've already looked at this. We can basically tell you guys that the first rate cut is pretty much expected and forecasted by the CME, by investors, to basically take place in June of 2024. Are we going to see a rate cut next month? That doesn't look likely, but we still believe that there's a strong possibility that they may start cutting in March. We think that there's a high likelihood this could actually happen. Again, because, basically they started raising rates 2 years ago, so that would be 2 years on the dot. And if they're holding for multiple meetings in a row, that means that most likely there's basically a zero chance that they're going to raise rates again, because the longer that they hold rates, the less likely it is in our mind that they're going to end up raising rates. And when we look at the charts here, we'll actually show you guys every time that the Fed has ever held rates, they've never, ever raised them again after that point. So you guys can see here, this is the current inflation rates. So you have your headline inflation, this is core inflation. So core inflation, we would like to see this come down. You guys can kind of see that the general area where it stayed was roughly between 1.7 to, I'd say, about 2.5%. This is kind of where the Fed wants to see it at. So we're still well above those levels. We're only down about 50% from the highs. And as for headline inflation, we're at 3.7%. But again, you guys can see that kind of the median area that we've been at is roughly about 1 to 2.5%. So we really want to see those numbers come back down to that area sooner rather than later, so the Fed can start printing money again. So the other thing that we're going to look at here, well, there's a couple more things. So you guys can see here that basically the Fed had paused in August, and they paused. Well, it looks like okay. So their last rate hike was basically, I guess, in July or August, something like that. But basically, since then, they've pretty much been at a pause. You guys can see that they have not raised, but they have not cut either. We saw something similar here. You guys can see in 2019, they didn't really move the rates that much. So they were basically sitting at the level they were at from January of 2019 to July of 2019. So about 6 months. And then, of course, they had to cut because of the pandemic. So there's that. Here's another instance, the 2008 crash. You guys can see that they had rates sitting at highs here from 2006 in July to July of 2007. So basically a whole year before they cut. And again, during the dot-com bust from June of 2000 to November of 2000. So that's 5 months. But the thing I want you to notice here, guys, is after they halted rate hikes, in every single instance, you can see that they never ever raised rates again. So this is historical data going back roughly about 25 years to go on. And of course, we have our trusty MACD indicator here. So we are seeing the MACD start to curl down. When this thing crosses to the downside, most likely the Fed will either at that point or shortly after that point start cutting rates. You can see it was almost perfectly timed here. And not quite perfectly timed here. It took a little while to actually play out, but shortly after that, they did cut rates. So roughly about 7 to 8 months after the MACD crossing. And again, here, we got to zoom out to see this one. So you can see that they actually started cutting rates before the cross. So it's not a perfect metric, but it does. When you see the MACDs crossing down like this is a technical indicator that kind of signals like, okay, the Fed may technically on a technical chart may be actually about ready to cut rates. And also the fact that every single one of these major market corrections that we had or Fed tightening cycles, you've never seen them raise rates again once they pause. So that's something to keep in mind. The yield curve itself has not uninverted yet. You guys basically have seen that the gap here has actually widened. So we're about a 40 percentage point gap in between the 2 and 10 year. As soon as the 2-year yield comes down below the 10-year, that's considered to be uninverted. And that's, I would say historically, and we did a video on this previously. You can go back and look under our macroeconomics playlist to find it. But we did compare the uninverted yield curve and the effects that it has on the stock market. So usually, I would say roughly about 3 to 6 months after the yield curve uninverts, historically is when we see a large market crash. So we're going to go ahead and take a look at the yield curve itself. So we got this US 02Y / US 10Y. So this is what we want to do. And as you guys, well, we got to get rid of this stuff first. So let's get this out of here. So as you guys can see here, basically what we're looking for is when it becomes uninverted, this is the spread, by the way, between the 2 10-year. It's just overlaid on one chart. But when it becomes inverted, it's going to fall below this 1% level. Okay. So anything under 1% is considered to be uninverted. Like we saw right here, this little stunt right here is actually considered to be uninversion. And then we became inverted again. So you can see that we went from basically being just slightly above uninversion to now substantially back above uninversion. But we want to see something like this. Like basically it comes down back below 1% and then it just doesn't come back up. It just keeps selling off like that. That's what we want to see. So there's one more thing that we're going to look at here to kind of base on what we think inflation is going to do with the CPI report coming up. And that would be oil prices. So we'll take a look at oil. We'll pull up the full size futures contract here and take a look at that. So we're actually needing to go to the weekly here. So we'll take a look at the weekly. As you guys can see, we have had a death cross on the weekly, and shortly after that, we had a huge drop. By the way, we were day trading this, and we did make quite a bit of money. In the last week, I think we made roughly about $500 or $600 trading the sell-off in oil. So, yeah, it's dropped about 15%. Why is this a good thing for CPI? Because again, food and energy, so the core inflation read excludes food and energy. Energy is oil and gas. Okay. That's what energy includes. It includes oil and gas. It may include some other things like hydrogen and stuff like that. I'm not sure. But the headline inflation report, with this having come down substantially basically over the whole month, we're expecting the headline to come down based on this alone because it does include energy and food. So as you guys can see, from the start of October to basically the end of October, we were down about 12.8%. So in theory, that should reduce the headline inflation by itself, but we'll just have to wait and see. Again, we've told you guys before, if energy is really going to be cooling off and, a lot of these dividend paying oil companies like ExxonMobil and Chevron are going to come down substantially, we'd like to see oil come down to this macro bottom support level here. Well, I mean, maybe to $30 to $43 a barrel, but if it comes down to 60, we'd be pretty happy with that. So we'll take a look at these stocks just to kind of see the effect that dropping oil prices have had. So yeah, you guys can see that Chevron was sitting up here at the highs for a minute, and they were recently at the highs in basically last month, and we saw a huge drop off just from this point alone, 17%. So if you guys are invested in Chevron Mobile, or CVX Chevron company, then you're getting some discounts here. And XOM, which is the other major big one, you guys can see that we have sold off quite a bit. So we had this triple top here. As you can see, that's a very bearish formation. Usually that's, you don't often see a triple top, but that's a pretty strong indication of a sell-off coming. And from September to basically right now, we've seen about a 15% drop on this as well. So you guys can see that oil is actually affecting these oil companies and causing the price to come down, which energy is included in inflation. And if that oil comes down, then theoretically inflation should also come down. So anyways, hope you all enjoyed this content. If you guys have any questions, leave them in the comments below. Please like, comment, and subscribe, and we will see y'all later. Peace.